Have you ever wondered how decisions made by the Federal Reserve could impact everything from your paycheck to the price of your next home? Well, today, we're diving into some breaking news that could have significant implications for the economy and your investments. Just hours ago, the Federal Reserve made a pivotal announcement. They're hitting the pause button on interest rate hikes. But what does this mean for inflation, stocks, and the housing market moving forward? We'll unpack all of this and more, giving you the insights you need to navigate these uncertain times. So let's jump right in. Federal Reserve's pause on rate hikes, what it means for you. The Federal Reserve's recent decision to halt further rate hikes marks a significant pivot in monetary policy with broad implications for consumers and investors alike. By opting to maintain interest rates at current levels, which are among the highest seen in decades, the Fed signals a cautious stance amid ongoing economic uncertainties. This move suggests a deliberate approach to balance economic growth with inflation containment. For consumers, this means potentially stable borrowing costs in the near term, affecting everything from mortgages to credit card rates. Investors, on the other hand, interpret this decision through the lens of market dynamics, where the prospect of prolonged higher rates could influence stock valuations and sectoral performances. As the Fed navigates evolving economic data, its stance on rates will continue to shape market sentiment and investment strategies, underscoring the importance of staying informed and adaptable in today's financial landscape. Understanding the inflation landscape. Inflation remains a focal point for the Federal Reserve as it gauges the health of the economy and deliberates on future policy moves. Recent data indicates a mixed picture. While headline Consumer Price Index, CPI, has moderated slightly to 3.3% annually, core CPI, which excludes volatile food and energy prices, also showed signs of stabilization at 3.4%. These figures reflect ongoing price pressures across sectors, albeit at slightly lower rates than earlier in the year. The Personal Consumption Expenditures, PCE Index, another key inflation gauge, similarly suggests persistent inflationary trends, albeit with recent fluctuations. For consumers, higher inflation translates into increased costs for goods and services, impacting purchasing power and budgeting decisions. From a policy perspective, the Fed's commitment to monitoring inflation closely underscores its mandate to achieve price stability while supporting sustainable economic growth. As inflation dynamics evolve, so too will the Fed's response, potentially influencing future interest rate decisions and economic outlooks both domestically and globally. Impact on the stock market. The Federal Reserve's decision to pause interest rate hikes has sent ripples through the stock market, particularly affecting investor sentiment and market dynamics. Over recent months, the S&P 500 has notched an impressive streak of record highs, largely underpinned by expectations of future rate cuts and the performance of tech behemoths like Microsoft, Nvidia, and Apple. These companies alone constitute a significant portion of the index's gains, highlighting concentration risks within the broader market. Despite the headline-grabbing highs, the disparity is stark when compared to other indices like the Russell 2000, which tracks smaller U.S. companies. This index has languished, echoing concerns about market breadth and the sustainability of the current rally. Some analysts argue that the outsized influence of a few mega-cap stocks may obscure underlying vulnerabilities within sectors less represented in major indices. Looking forward, market sentiment remains mixed. Optimists point to substantial liquidity on the sidelines and bullish projections from major financial institutions like UBS, which predicts further gains in the S&P 500, driven by robust profit growth and investor appetite for technology stocks. Conversely, skeptics warn of a potential correction, citing historical parallels to previous market bubbles and the inherent risks of over-reliance on a handful of market leaders. Housing market dynamics. The housing market, a cornerstone of the U.S. economy, is experiencing nuanced shifts in response to the Federal Reserve's monetary policy decisions and broader economic trends. Recent data from Zillow and Redfin reveals a complex picture. While median home prices have soared to unprecedented levels, signaling robust demand, there are emerging signs of moderation and adjustment. Throughout the past year, the market has grappled with supply constraints exacerbated by the pandemic's lingering impacts and persistent labor shortages in construction. However, the tide appears to be turning slightly, with a notable increase in housing inventory compared to previous months. This uptick in listings suggests a potential easing of the tight market conditions that have characterized recent years. Despite these positive developments, challenges remain. Affordability concerns persist, driven by elevated home prices and rising mortgage rates, which, though tempered recently, continue to influence buyer behavior. Furthermore, regional disparities in housing dynamics underscore the uneven nature of recovery across different markets. Looking ahead, forecasts from housing analysts suggest a more moderate pace of price appreciation, aligning with broader economic trends and the Federal Reserve's cautious approach to interest rates. This adjustment could provide some relief for prospective homebuyers while maintaining a healthy level of activity in the housing sector. Federal Reserve's projections and economic outlook. The Federal Reserve's latest projections offer a glimpse into their outlook for key economic indicators and monetary policy decisions. Central to their forecast is the trajectory of inflation, which they anticipate will gradually ease from current levels to reach 2% by the end of 2026. This cautious optimism hinges on assumptions of sustained economic growth, albeit at a moderate pace, and a resilient labor market. In addition to inflation, the Fed's projections include expectations for GDP growth and unemployment rates. They foresee GDP growth remaining in the vicinity of 2%, reflecting steady but not robust expansion. Unemployment is also expected to hover around 4.2% by 2025, indicating a stable labor market despite lingering uncertainties. Regarding interest rates, the Fed signaled a shift in their stance by projecting rates to stay at 5.1% throughout 2024, higher than previously anticipated. This stance underscores their commitment to taming inflationary pressures before considering any rate cuts, aligning with their dual mandate of promoting maximum employment and stable prices. Global economic factors and geopolitical implications. Beyond domestic developments, global economic factors are exerting considerable influence on market dynamics and geopolitical relations. One significant development is the BRICS nations' collective divestment from U.S. treasuries, marking a strategic move away from traditional dollar-denominated assets. This shift underscores broader concerns about currency diversification and global economic rebalancing. Moreover, China's actions, including rapid reductions in U.S. Treasury holdings and shifts in trade policies, reflect its evolving geopolitical strategy and economic resilience. These maneuvers have ripple effects across global markets, influencing currency valuations, interest rates, and international trade dynamics. Geopolitically, tensions and strategic realignments are shaping economic policies and market sentiments worldwide. The interplay between economic interdependence and geopolitical rivalries underscores the complexity of global economic governance and market stability. As nations navigate these dynamics, vigilance and adaptability will be crucial in managing risks and seizing opportunities in an increasingly interconnected global economy. In conclusion, while the Federal Reserve's decision to pause rate hikes offers a momentary reprieve, the economic landscape remains fluid and interconnected. From inflation pressures to market volatilities and geopolitical maneuvers, each factor plays a critical role in shaping our financial future. As investors and consumers, staying informed and adaptable will be key to navigating these uncertain times with confidence. If you found this video insightful, don't forget to like, subscribe, and hit the notification bell for more updates. Stay tuned for more in-depth analyses and expert insights. Until next time, take care and invest wisely.